In this video, we'll be covering what mortgage insurance is and the two different types you'll find. Hey, what's up? I'm Mark Bellini, and I'm all about achieving financial independence through real estate investing and online business. So if you're new to the channel and you're looking to achieve financial freedom for yourself, be sure to hit the like and subscribe button down below. It really does help me out, and I'll keep cranking out these videos. If you're in the market to buy a new home and you're putting down less than 20%, you're going to pay something called mortgage insurance. And what this insurance does is it protects the lender in case you default on your payments. And so you're going to have to pay a little bit extra on your monthly mortgage every month. It's going to be, $50, $100, whatever it is. It kind of depends on the size of your loan. But you're going to pay that for a certain period of time. And so there are two types of mortgage insurance. There's PMI, which is private mortgage insurance, and then there's MIP, which is mortgage insurance premium. And they work basically the exact same way, but there are some differences. So if you're going with a conventional loan, you're putting down 5%, 10%, 15%, something like that, you're going to use PMI. And the thing about PMI is you're going to pay that until you reach 20%. And at that point, you can call your lender and say, hey, I've reached 20%. I would like you to remove the PMI fee from my monthly payment. And at that point, they will remove it, and you won't have to pay it anymore. And if you don't call them and request that, I believe it drops off after about, I think it's like 22%, so a couple percentages higher than 20%. And at that point forward, you won't pay it at all. So no matter what, if you have a conventional loan, you have PMI, eventually it's going to drop off and you won't have to pay it anymore. Now, if you get an FHA loan and you put down 3.5%, that's going to include MIP, which is the mortgage insurance premium. And the difference is that one does not fall off. It stays on for the entire life of the loan. So you're going to pay it from day one, you're going to pay it to, year 25, just going to pay it the entire time. I believe there are some situations where it can be removed if you put like a larger down payment, but it doesn't really make sense to do a larger down payment in an FHA loan. It doesn't really make sense. So you wouldn't really do that. So if you do that, if you put down 3.5% and you're purchasing a house, to get rid of that in the future, you're going to have to refinance the loan and get a new loan, and then that, fee will drop off and you won't have to pay it anymore. So I just want to cover those two, mortgage insurance premium and private mortgage insurance. So personally, I think it's better to go the private mortgage insurance route because that way that fee drops off eventually. And also one quick tip on that. So if you buy a property and let's say it's worth $500,000 and you're paying PMI every month, after 2 years, after you own it for 2 years, let's say the value of the property has appreciated substantially and you have reached that 20% equity easily. So you can call your mortgage or your lender over after 2 years and say, hey, I believe my property is worth more and I would request that you please remove the PMI. And at that point, they usually do remove it if the value is there. So just a quick tip on that as well. So if you like this content, be sure to like and subscribe, and I'll see you in the next video.